Hey guys, welcome back to Toto Capital. My name's Liam, and in this video, I'm going to share with you a very insightful and educational view on how to trade fair value gaps. So, I started trading about 6 years ago while I was at university. So, it all started originally. So, I had a corporate exam coming up, and it was the end of a lecture, and I approached my lecturer, had some comments and questions regarding an upcoming exam. And it was actually during the NFP news release, and my lecturer had some charts on his screen, and I asked him, I said, what on earth is that on your screen? It was NFP news release. Everything was going absolutely crazy. Charts were moving up and down, and the volatility was absolutely crazy. And what my lecturer was trading was smart money concepts, strategies about 6 years ago when they weren't very popular, they weren't really taught about, and there wasn't actually much material out there on YouTube, on forums, etc. Okay. And yeah, that was 6 years ago, which is actually quite crazy to think about. And, I sat down for hours with my lecturer because I was extremely enthusiastic, keen, and willing to learn. And, we used to sit down once a week over the course of my university career. And yeah, he literally taught me the ins and outs and everything that I needed to know. Okay. And this was 6 years ago when I was at university. I studied corporate finance, so mathematics and finance at university. And yeah, very, 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 very interesting. But that was 6 years ago, which is absolutely crazy. So yeah, let's just jump into this video, guys. This is fair value gaps, which are pretty much one of the most important concepts when it comes to smart money trading, when it comes to SMC. And yeah, exactly what are fair value gaps? So let's just jump straight in. So fair value gaps are essentially jumps in price that are caused by imbalanced buying and selling pressures. These gaps are sometimes called price value gaps or singles, and you may also encounter the term imbalance. So a lot of people refer to them as a imbalance. In this article and video, we will use the term fair value gap, also referred to as a FVG. Okay? Fair value gaps indicates a market situation where the supply of buyers is significantly higher or lower than the demand of sellers. So this can cause the price of an instrument, asset, or equity to move quickly towards higher supply or lower demand. So the fair value gap then shows the point in the chart where the rapid price movement occurred. So in simple terms, essentially, where did price speed up, or where did it speed up to the upside, or where did it speed up to the downside? Okay. And essentially, fair value gaps can act as a essential magnet where price likes to refer to, retrace to, grab more orders, and then further continue in the desired direction. Okay, so just understand fair value gaps can act as a magnet of price where price likes to refer back to rebalance the orders, and then we can then continue in the desired direction. So essentially, a bullish fair value gap is created when there's a gap between the high of the first candle and the low of the third candle. So this is the high of the first candle and the low of the third candle. So it's a 3 candle pattern, and yeah, high of the first candle, low of the third candle. So if there's a gap between them, this is a fair value gap where we would look for price to trade back into, and then we would look for a potential long setup on the market. Vice versa, what is a bearish gap, or a bearish fair value gap is created when there's a gap between the low of the first candle and the high of the third candle. So the low of the first candle and the high of the third candle. So if there's a gap between them, this will create a bearish fair value gap, where we can look for a retrace into this area and look for a further short setup to go with the volatility, which is to the downside. Okay, so also understand that, fair value gaps, the higher the time frame, the more significant that these fair value gaps are. So for example, daily, weekly, monthly, etc., very, very significant. When you start dropping down to like the 5 minute, the 1 minute, etc., these fair value gaps are not very significant, and they do not have as much of a weighting in terms of being, a more reliable indicator on predicting future price movements. Okay, so understand daily, etc., and anything higher is a lot more significant when you're trading the markets. So now let's head over to the charts so we can run through some live examples and I can show you guys some real life setups. Okay, so this is Euro USD on the daily time frame. Obviously, please note that these concepts can be used across all asset classes. Liquidity is fractal across all markets, okay? So they all behave pretty much the same, but it's still very important to do your own live testing, back testing, and forward testing to ensure that you actually have an edge within the markets. So this is Euro USD, daily time frame. And now let's have a look at identifying our fair value gaps. Okay, so this is daily time frame. We can see we've got a daily fair value gap right here. The reason why is, remember, we identify it. So from the first candle's low to the third candle's high. So this gap right here, is there a gap between this area? Yes, there is. The first candle's low to the third candle's high. So we have a bearish fair value gap here, indicating that sellers are in control of this market. We have an imbalance in price showing, sellers really pushed price to the downside very strongly. And basically, there was no real buying pressure at all. Okay, so between this area, there was really no buying pressure, hence the word or term imbalance. Okay, so in terms of actually executing, you want to execute basically around the 50% retracement of the imbalance. This ensures that you're getting a nice discount on the market. So head over to the left, grab the Fibonacci tool, drag that from the imbalance high to the imbalance low, and you can look to execute on a 50% retracement of this fair value gap. In terms of an invalidation, this is very, very important. Okay, you can see this is the second candle here of the pattern, and therefore we can have an invalidation above that candle high. So let me just remove the Fibonacci tool right here, and let me just mark on that candle high for you right here. So basically, we have an invalidation above that candle high because essentially that is a form of resistance. So we have two essential confluences right here for our invalidation, because we have an area of liquidity, which is this fair value gap right here. So we have an area of liquidity, okay? We have an area of resistance, okay? And that is the two confluences that we have to get short in this market. So we have a fair value gap, which is the area of liquidity. We have a resistance right here, and we have external liquidity where we can look to target. Can we get a 1-to-1 at least down to that low? And yes, we can. We can get a 1 to 2.13 if we take a 50% retracement of this daily fair value gap. Okay, so we're looking for price to trade back into that daily fair value gap. You can see we're triggered short in this trade right here. And in terms of targets, we're looking to target external range liquidity. So we're trading from internal range, which is right here, internal range liquidity, to external range, which will be right here. Okay, so we triggered short on this trade, and you can see the 1 to 2 risk to reward was hit on this trade. Okay, so essentially the lowest hanging fruit is the external liquidity, which is just the low right here. Yes, price may continue lower, and it may, continue to a 1 to 3, 1 to 4, etc. However, I like to take the lowest hanging fruit where the highest probability setups are. So now that that's a sell setup, let's take a look at a buy example. Okay, so now let's look at a buy example. Euro USD still on the daily time frame. As I said, these tend to work in terms of a daily bias sort of more frequently and at least more consistently on the daily time frame. Okay, because these fair value gaps are very, very significant. So what we can see here, marking this on the chart, we have created a fair value gap, a imbalance to the upside right here. Okay, because what we taught originally, so from the first candle's high, so the first candle's high to the third candle's low, is there a gap between that? Yes, there is. Yes, there is. So I've marked that on in this gray shaded area here. This marks on the fair value gap, and therefore we can take our fib tool and look for a retracement into 50% of that fair value gap. Let's just extend that out. So, you could either market execution or look for a limit order if you want to wait for price to come into that area. In terms of a invalidation, stop loss is going to go below the middle candle's low. Okay, so as I said, this is like a 3 candle pattern, 1, 2, 3. The middle candle, candle number 2, you've got a stop loss below there. Why do we have a stop loss below there? One, because this is essentially a support, okay? And then we're stacking confluences together, i.e., number 1, we've got a stop loss below support. Number 2, we've got a liquidity, which is a fair value gap, and that means price has got to violate both of them confluences in order to invalidate our bias. Okay, so we're giving multiple confluences stacked up together to give ourselves the best possible chance for the trade to play out. Then finally we ask ourselves, okay, can we get a 1-to-1 up to the high? Yes, we can. It's a 1 to 1.81. Absolutely fine, around a 1 to 1.8. And let's allow this to play out. You can see we're triggered in right here. We've got clear invalidation, clear target. Let me just mark the target on up at range highs and then just play this out. So this has taken a trade from internal liquidity, which is your fair value gap, up to the most logical, which is external liquidity, which is just resting at this high right here. Okay, you can see price did sort of play around a little bit. There was a little bit of drawdown, but I guess it's good to show you that not all trades just sort of ping your fib or ping your entry and they're going to go straight into profit. Okay, it's nice to show an example that isn't entirely textbook. So this is a great example, a long example on Euro USD. Just to summarize what we've covered today, so these are fair value gaps. Essentially, a bullish fair value gap is created when there's a gap between the high of the first candle and the low of the third candle. So the high of the first candle is right here. The low of the third candle is right here. So if there's a gap between them, that creates our fair value gap, indicating a displacement and leaving behind an imbalance in price around that area. In terms of a bearish fair value gap, that is created when there's a gap between the low of the first candle and the high of the third candle. So this is the low of the first candle right here. This is the high of the third candle right here. If there is a gap between them, so i.e. if they do not overlap, this will create a bearish fair value gap, indicating displacement to the downside, which has left an imbalance in price right here. Okay. One final thing I just want to touch on is, I know at the start I mentioned that I went to university and I studied mathematics and finance, and I was actually taught from one of my lecturers. I think it's very important to touch on that. You do not need an education or university to even learn how to trade. Okay, because these are just pattern recognitions, and you're just trading a probabilistic pattern over and over again. Okay, so you do not by any means need any form of university or anything like that. That doesn't really sort of help or increase any sort of further knowledge. Most of the stuff's out there for free, or at least is available out there. You don't need to pay for university, and that's certainly not something that I'd recommend if you did actually want to get into trading. I guess it was just very lucky that I came across one of my lecturers that was visiting from New York, so he's based in the UK, on a essential placement from New York. So, but yeah, that's it for this one. I hope you did enjoy that on how to trade fair value gaps, and I will see you in the next video. Take care, guys. Bye bye.